Suppose this is the balance sheet of a firm as on 1st April 2010. Capital 10,000 rupees, cash 10,000 rupees, and the total on both sides 10,000 rupees. And the following is the profit and loss count for the year ended 31st March 2011. On debit side, opening stock 0, purchases 5,000, expenses 1,000, depreciation 1,000 to net profit 2,000, total 9,000. Credit side, buy sales 9,000, buy closing stock 0, 9,000 rupees. These are the only information given to you, and you are asked to calculate cash from operation. You know, net profit and cash from operation is one and same thing. If net profit has been calculated on the basis of purely cash transaction and operating activities. In this question, you can say there is no change in any current asset, but on debit side, there is one item of rupees 1,000, that is depreciation. It means this is the non-cash transaction, and your net profit of rupees 2,000 is also influenced by rupees 1,000. If we remove the effect of depreciation from this profit and loss count, then we'll be at the net profit on the basis of purely cash transaction, and that net profit will be called cash from operation or cash generated from operating activities. So you know the formula of this thing, net profit plus depreciation. 2,000 plus 1,000 is equal to 3,000. This 3,000 is the cash from operation. So it's quite simple. So you have learned that any non-cash item will be added back to the net profit if you find any non-cash item on the debit side of profit and loss count. So let's see what can be the items which are non-cash items and they are found on the debit side of income statement, or you can say profit and loss count. You know, all these items are added back to the net profit. So I'm giving you some examples which you may find on the debit side of profit and loss count, and they are non-cash items and they must be added back to the net profit to reach cash from operation. So the list is net profit plus depreciation plus transfer to reserve plus transfer to any fund, any intangible asset written off plus any fictitious assets written off plus provision for tax made plus dividend proposed plus interim dividend paid or proposed plus loss on sale of fixed asset and minus profit on sale of fixed asset. That will be equal to cash from operation. So these are the items you may find on debit and credit side of income statement, which are purely non-cash transaction. Recently, we were discussing about how to calculate cash from operation. And if you are given income statement, so what was our strategy? That net profit is the same thing. I mean to say, net profit is the cash from operation if net profit is calculated on the basis of cash transaction. But sometimes there are non-cash transactions on debit side and on credit side of income statement. So what we used to do, we used to add back or deduct from the net profit, and we were at the cash from operation. One thing more I would like to tell you here, that there are also some items on debit side and credit side of income statement. They are cash transaction, they are cash items, but they are not operating. You know, all incomes and expenses are categorized into two categories: operating expenses and non-operating expenses, operating incomes and non-operating incomes. Let me explain you one more thing. Suppose you are paying interest on long-term loan. If you pay the cash, that's a cash transaction because you are paying interest, and that will be placed on the debit side. But this expenditure is cash transaction, but it's not a operating transaction. I mean to say, it is not operating expenditure, or in other words, this is not the operating activity. And in the same way, if you have invested money in long-term asset, I mean to say in some long-term investment, naturally you will get some interest. That will be your income, and that income is always placed on the credit side of income statement. That income, I mean to say interest on investment, that's a income, that's a cash transaction, but it is not a operating activity, because any income on long-term investment is not a operating item. So we will have to remove the influence of these non-operating items from the net profit so that we can reach cash from operation. So if you find any interest on long-term loan on the debit side, that will be added back to net profit so that we can reach cash from operation. In the same way, if you find any item on the credit side, I mean to say credit side of profit and loss account, that is always income. If you find any interest on long-term investment on the credit side, that will be deducted from the net profit so that we can reach cash from operation. Suppose there is profit and loss account. On debit side, opening stock 0, purchases 5,000, expenses 1,000, interest on long-term loan 1,000, to net profit 2,000, total 9,000. On credit side, by sales 9,000, by closing stock 0, total 9,000. So the net profit in this profit and loss account is rupees 2,000. Can you call it cash from operation? Is it on the basis of cash transaction? Yes, it is purely based upon the cash transaction. But one problem is there. This firm has paid interest on long-term loan. This is cash transaction, but this is not the operating activity. I have already told you, interest paid on long-term loans or interest received from long-term investment, they are non-operating activity. So I want to remove the influence of this non-operating activity from this net profit. So what's the formula? What's the way? Take the net profit and add back this interest on long-term loan of rupees 1,000. You will be at net profit, which is purely based upon cash transaction and operating activities. So 2,000, I mean to say net profit, plus interest on long-term loan 1,000, total 3,000. This is the cash from operation.